as house prices going up 8% and mortgage rates coming down. That's what I'm covering today on episode 130 of Canadian Mortgage Weekly. This is Canada's only weekly mortgage video news podcast geared towards mortgage holders and borrowers. Really looking forward to getting this information to you today and working with you all to educate you to get a good mortgage after bankruptcy. Or if you're here for the common stats and statistics on mortgages that I go over with every morning on Thursdays on Canadian Mortgage Weekly, that will happen shortly. So, yes, episode 130. Thank you to all my dedicated followers here on Canadian Mortgage Weekly Live. Great to be here with you on episode 130. So, just before I get started, if there's any comments, please leave them in the comment section. I'll try to get to each and every one as I go through this episode today. Expect to spend about 20 minutes with me as we go through this information. So, mortgages after bankruptcy. Well, what does that look like? And can you even get a mortgage after bankruptcy? And keep in mind, consumer proposals, they count as well as a bankruptcy. And why do they count as a bankruptcy when they are not a bankruptcy? Well, in the lending world, especially the mortgage lending world, a consumer proposal or bankruptcy are looked at one and the same. And in my 13 years in the mortgage industry, I've seen clients do both and lenders treat those clients the same way, especially when it comes to trying to get a low rate, excellent mortgage going forward. So I'll talk a little bit about what the banks are looking for from everyone when they are getting a new mortgage after they've claimed a bankruptcy or a consumer proposal. My goal in this episode is to educate you all as to what you need to do once you claim bankruptcy or consumer proposal and how to follow through on the steps with what the banks and lenders want to see to get the best mortgage possible, the best mortgage money, or the highest mortgage money on your purchase that's available. So, if you have any questions, please leave them in the comments. I'll try to get to them towards the end of the episode, or actually through the episode if possible, if I can interject there, and we'll go through those. Okay. So one of the things that I always tell my clients when they've come to me and have gone through a bankruptcy or a consumer proposal and are asking me, Joe, what steps do you need to take? I know that you helped my friend get a home. They went bankrupt in the past and they worked with you. What do they need to do to move forward after bankruptcy? Well, it's not a quick fix. It is going to take some time. It's going to take patience and careful planning. So here are some steps just to get started. If you don't know what steps to take, I'll talk about some steps. I'll talk about an example of someone who's gone through it. And then I'll talk about the 4 things that the lenders need to see from you on a file once you've claimed bankruptcy or consumer proposal. So here are some steps that you need to take just to get started. The first step I would recommend is to obtain a copy of your credit report. Now, you can do this through your app on your banking app, for example, and get a score that way. But that's not really going to help you in terms of what you're looking for. You're going to want to make sure you get a full credit bureau. You can order one online, but that does cost about $20 to $30. The best way I recommend everyone do this is that everyone is entitled to 1 free credit report per year from either Equifax or TransUnion. And you can actually get this by sending snail mail to their reporting center and requesting a credit bureau in writing. providing your address and identification. I think you need 2 pieces of identification, and they will mail you back a copy of your credit bureau. From that, you can make sure that your credit report is accurate and represents all the debts and accounts that were included in the bankruptcy or consumer proposal. So one thing I noticed a lot when working with clients is they would come to me years after their bankruptcy or consumer proposal, and their credit file wouldn't even have all the accounts included that should have been. For example, if you went bankrupt and zeroed out 7 different credit cards in a line of credit, maybe Equifax didn't get all those updates and are only showing that you zeroed out 5 credit cards in one line of credit. So there's 2 credit cards there sitting that are coded not included, but they should have been included. And that once we get those errors corrected, which I can help with that, your score goes up tremendously, because all this time it's reporting a late payment, a late payment, a late payment, a late payment. So you want to avoid that. So make sure you get a copy of your credit bureau. All right. Another good step I always recommend is to make a budget after you claim bankruptcy, because you're going to want to make sure that you don't fall into the same steps again. Living within your means, making sure you have on-time payments, and that you can show the credit bureaus that you're financially responsible. And that's really going to translate well with where you need to be when the lenders are looking at your report for a mortgage post-bankruptcy. All right, the first thing you're going to want to do before you get a mortgage is to get discharged as well. And that can take a few years, or you can just get discharged right away. I've actually seen clients, when they own a home, get discharged almost right away by using the equity in their home to help them with their discharge. But essentially, you really can't start any of this until after you're discharged. So one of the things you're going to need to do is to get discharged from your bankruptcy or consumer proposal. And once that is done, you're going to want to open a secured credit card account. And a secured credit card, the way it's different, and it does require a cash deposit. And that cash deposit serves as collateral. You have to remember, the reason why they're asking for this is because they see that you've just written off all these accounts and want to make sure that you're going to be able to repay this type of credit. Once you get this type of card, it'll become easier all of a sudden to obtain unsecured credit cards, especially if you use your secured credit card a little while. This can also help rebuild your score, and I'll get back to this a little later. You're going to want to make sure you make those payments on time, paying all those secured credit card bills on time, and avoid any late payments. Any late payments after bankruptcy or consumer proposal are going to look 3 times as bad than they did prior to your consumer proposal or bankruptcy. So do not miss any minimum payments whatsoever. This can completely hinder your progress and add years to reestablishing your credit. And as you're doing this, you might want to also consider a small installment loan. When I say installment loan, would mean like a consumer loan or a small car loan. I don't ever recommend going and buying a $60,000 truck or minivan after bankruptcy and using that as your installment loan. That is quite a purchase. If you can do a small installment loan of $1,000 to $5,000, that will be more than enough to show the credit bureaus that you are making those payments on time, and that would also help rebuild your score. Because you have to also consider credit cards are a big part, but also loans are a big part, because they're a different type of credit, and different types of credit also contribute positively to your score so long as you're making those payments on time. So as all this is happening, You're going to want to make sure you monitor your credit score, keep track of it to ensure that it is improving. And you can do this free through your banking apps, or you can do this through a online paid account through Equifax or TransUnion. Or as I mentioned, you can request a free credit report by writing the Equifax or TransUnion reporting offices. And as I mentioned in the beginning of this episode, being patient after your bankruptcy is key. It does take time. You don't want to rush it. As we meet to discuss your mortgage and get things rolling, you're going to want to make sure that you are implementing everything that is recommended, being patient and financially responsible. Most important thing will be to remain consistent and responsible with your credit use. And with time and effort, you'll be able to rebuild your credit and improve your financial future. So, for instance, here's an example of, I'm going to talk about an example here of someone who's reestablished their credit after bankruptcy. This is someone that has successfully improved their credit score. Once you claim bankruptcy or consumer proposal, your credit score will most likely hover in the 400 or 500 range. You will show accounts that have been written off, included in the bankruptcy, included in the proposal, and those will stay on your record for quite some time. So you're going to want to make sure that any new credit is completely clean and good. And as that new credit comes along, the new credit and the history from that new credit begins to contribute positively to your score. And the more you contribute positively to your score, it's going to offset the negative items that are showing on your credit bureau. For example, as you're successfully improving your score, you're going to want to make sure that you're keeping your payments on time. You're going to want to make sure you're keeping your credit utilization low. So credit utilization is something that a lot of people I find don't understand, but it's pretty simple. So credit utilization would refer to the ratio of balance versus limit on your credit account. So one way I could explain this is you have someone that has a $500 limit on their credit card. If you hold a $400 balance, is that better than a $400 balance on a $5,000 limit credit card? Well, no, it's actually way worse, because $400 balance on a $500 limit shows the credit bureaus and lenders that you're using 80% of your credit utilization, which is extremely high, and that's actually not going to contribute at all positively to your score. In fact, it could actually hinder your score going forward. If you have a $500 limit, you're going to want to keep that balance that shows up on your statement no more than $1 to $150. And one way I recommend people doing that is to make payments as much as you can on your credit card. If you buy gas, you go into your banking app and make a payment. If you buy groceries, you go into the banking app and make a payment. Even setting auto payments from your billing on your online banking, so it just sends money to your credit card every few weeks, is a great idea to keep that utilization low, because it's that balance showing up on your credit card statement that will be counted towards your credit utilization. Anyway, and as you make on-time payments, you're going to have good credit history. Any high utilization points will be reported on your credit bureau and kept for a few years. So especially if you go over a limit, that will be registered as a over limit, and that will also contribute poorly to your score. Once that's all done, you have the option to apply for vehicle loans or new credit cards that can help even further improve your credit history. And then as you do that, you'll eventually be able to get a mortgage. But how is that? How is someone going to be able to get a mortgage after bankruptcy? Well, here are some items that lenders will need to see on your credit file before getting a mortgage. First one is your credit score. Your credit score will need to have gone up minimum 600 or higher. Minimum. There's no way you'll be able to get a mortgage with minimum down payment with less than 600 credit score. As a matter of fact, it's even better if you have a 680 or above credit score. I know that can be really difficult, but one way to make sure this is happening is to make sure that your payments are on time, that you have low utilization, and that you have checked your credit score and made sure that all the accounts that were included in the consumer proposal or bankruptcy have been reflected as such on your credit bureau. That will help make sure your credit score is as high as possible. As I mentioned, getting that secured card first, then getting an unsecured card, and a small installment loan will all contribute positively to your score. If you're looking at interest payments on that installment loan and the interest is high, that is going to happen. Your interest will be high for the first little while as you go through this credit rebuilding season in your life, and consider it a cost of doing the bankruptcy. You'll get lower interest rates very shortly. All right. Payment history. Lenders will not only look at your score, which your payment history reflects, but they will look at to see your payment history since the bankruptcy. So making sure your payments are on time, seeing how you handle your outstanding debt, seeing if you're going over limit, seeing if you're going close to your limit, seeing if your limits have actually increased. That's actually a good thing on your credit score and credit bureau score. You want to make sure your credit limits are increasing. See how many credit cards you have and are actively using, and how well you're paying those off. So that's 2. Number 3 will be your debt to income ratio. Obviously, there is a little bit of that to play when you're getting a mortgage, but that's really in all mortgages. You want to make sure that you have good income and that you're spending below your means. So this isn't really something that I want to focus on because everyone has to have a good debt to income ratio, but I just did want to throw that in there just to make sure you're not trying to spend more than you're earning again once you're post bankruptcy. If lenders see that, they'll see you as a risk and most likely pass on the opportunity to offer you a mortgage. Number 4, well, really number 3, because number 3, the debt to income ratio was kind of a bonus one. So number 3, length of credit history. This is a big one. A lot of clients, they claim bankruptcy or consumer proposal, they wait 2 years, and then they come to get a mortgage. Well, that's great. However, you're going to want to make sure that you have reestablished credit, as I mentioned, a new secured card, a new unsecured card, possibly a small installment loan. And you're going to want to make sure you've had some history with those accounts. So before you even apply for your first mortgage after your bankruptcy, you're going to want to make sure that you've had those credit card accounts for at least 12 months. And why do I say that? Well, and you know what? It's even more important that those 12 months and those credit cards were opened up post discharge. Because I've seen clients keep one credit card active through their whole bankruptcy, through their whole consumer proposal, and after. And the credit history is good on that. But they're not going to count that one. They will not use that history whatsoever. The lenders on mortgages will only use the history for cards that are issued post bankruptcy. This is very important, and a lot of people miss this part in their credit reestablishment. So length of credit history on new accounts that are advanced to the client post discharge of consumer proposal or bankruptcy. Longer credit history with good history will make your opportunity to get a low mortgage rate and the most mortgage money very good. Keeping in mind, you're going to want to show 12 months minimum of credit history post discharge on your credit cards and your installment loan if you've decided to go with an installment loan. They're also going to want to see recent credit activity. So it's not something that you want to just get a credit card once you're discharged, use it one time, pay it off, and put it in the drawer. They are going to want to make sure you've been using it actively to show that you can maintain use and maintain a good status with your credit card. That's really important, and they're going to need to see that. So 4 things that I mentioned here are credit score. You're going to need a minimum 600, better even still 680 credit score. Number 2, you're going to want to make sure you have good history on your payments, that they're on time, not late, because late payments post bankruptcy or consumer proposal discharge look 3 times as bad as before your consumer proposal or discharge. Length of credit history. That's a big one, because you're going to want to make sure you have 12 months history on a new account that's offered to you post discharge, right? So that's really important. And number 4, recent credit activity, so that you are continuing to use those accounts and that your balances are not close to the limit. The fact that a lot of people think that a $400 balance on a $500 limit credit card is okay completely can ruin a credit score, especially if you're working on reestablishing your credit post bankruptcy. So some things to really consider, and something that you will want to set yourself up with going forward. And if you have any questions, you can let me know in the comment section. I will try to answer those for you as we go through this information. So one thing I wanted to go through here is my presentation, so you guys can see here what we're talking about in terms of mortgage news. A lot of good things happening in the mortgage market. On the 25-year amortization on a new mortgage, you're looking at a 5% down payment with a monthly payment of $2,679.40 with an interest rate of 4.69 or better. On the refinance, if you own a $900,000 home, your maximum refinance amount will be $720,000 with a monthly payment of $3,950.70 at a rate of 5.24% or better. Okay. Now, the 5-year bond yield, reason why I talk about bond yield a lot is because 5-year fixed rates are based off the bond yield. And I've tried to really show you here that they have really been decreasing. We had a little bit of a bump here in the late to early 2022, 2023. But overall, we have seen a decrease. This big decrease here was spurred on by the Silicon Valley Bank collapse. And we'll see how this goes forward now. Will rates continue to drop? I don't know, but 5-year fixed rates have dropped. The 5-year fixed rates have dropped 30 to 40 basis points now. And a lot of clients have gotten their pre-approvals through me at a lower rate now than just a few months ago. Inflation rate is headed down in Canada, 5.2% currently, with a high of 8.1% in June of 2022. It's great to see that inflation is so low compared to last year. Still very high overall, but it's gaining momentum on its downward trend. Same for the United States. As you see, inflation is now down to 6% from a peak of 9.1% in June of 2022. All right, what else do we have here? We have the CDOR rate, which is the interbank rate. This is what I tend to use to see if variable rate mortgages are a good competitive option. And they were when the CDOR rate was down here, but they're not so competitive anymore that it's gone up to here. So because the variance to prime is so low, we really don't have any good deals available on variable rate mortgages right now. And because of that, I really recommend that when you talk to your mortgage professional, that you consider fixed versus variable and see what is right for you. Whatever is right for you can really be determined by your goals and home ownership plans for the next few years. The jobs report has been increasing steadily, and because of that, they will not really lower rates until people start losing jobs. So unfortunately, that is one of the downsides of lower rates. However, it's great if you're looking for a job right now. Prime rate is down at 6.7% as of today, March 30th. This is the overall trend of prime rate. We have seen great prime rate drops since the 1980s. Overall, for variable rate mortgage holders, it's most recently that they've been skyrocketing. So if you have a variable rate mortgage, you know what I'm talking about. The next Bank of Canada announcement is happening on April the 12th, 2023. Join me for a live pre-rate show. That's just after Easter there, where we will spotlight the Bank of Canada's rate decision on April the 12th. See if they move the current overnight rate from 4.5%. See if they will go higher. I mean, they will go higher if the jobs report going up for March is of concern to them. But with inflation dropping to 5.1% and their Bank of Canada saying that the reason why they are raising rates is because they want to bring inflation back down to 2%, could just mean that they might keep the rates steady at this next rate announcement. What do you guys think? Right now, as you see, the last rate announcement, Bank of Canada held rates steady. And house prices, big news here, up 8% in February. So up at $662,437. Huge news. As you see, house prices bottomed out in January of 2023, the lowest we had seen since the February 2022 peak. Do you think that they will continue to go up, or is this just a minor spring blip? Because we did see a spring blip here and then with a further decrease. So we'll have to see. It's going to be interesting. We'll keep you updated here on Canadian Mortgage Weekly. And this average national house price translates to a $41,243.70 minimum down payment with a $3,644.22 monthly payment. And if you're doing 20% down, you're looking at a minimum down payment of 20% for this average priced home of $132,487.40 with a monthly payment of $202,904.68 on a monthly payment for a 30-year mortgage with 20% down. So with that in mind, I mean, it's quite hard to come up with $132,000 unless you're selling an existing home and you have some equity built up. However, it is fairly realistic for a first-time homebuyer couple to save $41,243.70. It's especially if both partners are full-time income earners, and it's even quicker if you're able to live with family for, say, 12 to 18 months, bank the rent you would otherwise have paid, and then use that rent towards buying your first home 18 months later. I would say that's the quickest way to be able to save your down payment without too much of a lifestyle change. In terms of spending, you're still able to afford Starbucks once in a while. However, if you really want to accelerate your down payment savings, I always recommend try to make your coffee at home all the time. Bring your lunch to work. Don't get a car payment. Buy a beater until your house is closed, and live with family. Those finance hacks can really build a robust down payment over the term of your saving. So anyway, that is episode 130 for Canadian Mortgage Weekly. It's great to be able to share this information with you. and to be able to be part of this podcast now for 130 episodes. Join me next week for episode 131, which will be our new theme for April. Can anyone guess our new theme for April? March was Credit Rebuilding Month, or Credit Education Month, actually. We covered off a bunch of different aspects of credit scores, how to reestablish credit, what is a good credit score. So for April, we're actually looking at National Home Remodeling Month, which is also Home Inspection Month. So with that, home remodeling, home inspections, they sort of go together. So we'll make sure that we connect with you next week with the best months to refinance your mortgage. And as we go into next episode, thank you for watching today. My name is Joe Bladek, host of Canadian Mortgage Weekly, Canada's only weekly video mortgage news podcast.